There is a dangerous moment in every great bubble when the public is told that it is not really a bubble. That is usually when the machinery has already been built to bring the public money in. Most people think a bubble begins when fools start buying nonsense. That is not quite right. A bubble often begins with something real, a real technology, a real breakthrough, a real company, a real product that changes the world. Railroads were real. Electricity was real. The internet was real. Fiber optic cable was real. Smartphones were real. Artificial intelligence is real. The mistake is not believing the technology. The mistake is paying any price for the technology at the exact moment the insiders need an exit. That is where the danger lives. Now, in the next stage of the AI boom, the question may not be whether AI works. It works. The question may not be whether SpaceX has built something extraordinary. It has. The question may not be whether OpenAI and Anthropic have changed the direction of software they have. The question is whether the public will be asked to buy these companies at prices that already assume a miracle. The machine does not ask whether the price is sensible. The machine does not ask whether insiders are selling. The machine does not ask whether earnings are clean. The machine does not ask whether the IPO is being priced for perfection. If the index says buy, the fund buys. That is the mechanism. And if the largest IPOs in history are quickly added to the most important indexes, then the retirement money of millions of people can become the buyer of last resort without those people ever making a conscious decision. That is not a small point. That is the whole story. A private company goes public through an IPO. Before the IPO, only certain investors can own it. Founders, employees, venture funds, private equity, sovereign funds, strategic partners, and insiders may have owned shares for years at much lower prices. The public could not buy. The public could only watch from outside. Then the IPO arrives, or maybe the window is open, prices are high, enthusiasm is extreme, and the sellers know that passive money can absorb what active investors might question. That is the question. Now, the NASDAQ 100 matters because it is not just another list, it is one of the great pipelines of modern capital. Many funds track it, many retirement accounts own it. When a company enters that index, funds tracking the index must buy. They do not buy because they love the company. They buy because the rule book says the company belongs there. That automatic demand is valuable. In the old world, a company had to wait. It had to meet certain rules. It had to have enough public float. Public float means the portion of shares actually available for public trading. If insiders own almost everything and only a tiny slice trades publicly, the stock can be hard to buy, hard to sell, and easy to distort. Float matters because it tells you how much real supply the public can access. If a giant company lists with a small float, the price can look very high on a small amount of trading. A small slice of shares can create a giant paper valuation. But if index funds are forced to buy based on a larger assumed weight than the actual float would normally justify, the demand can become artificial. That is where the rule change becomes important. If the waiting period gets shortened, the company can enter faster. If the float requirement is removed or weakened, a company with limited public shares can still qualify. If a low float is multiplied for index weight purposes, the funds may be required to buy more than the natural supply would suggest. That is how a market can look free and still be highly engineered. Now look at the scale. SpaceX, OpenAI, and Anthropic are not ordinary IPO candidates. They are cultural symbols. They represent rockets, Mars, artificial intelligence, frontier technology, national power, and the future. Those are powerful stories. The market loves a future story because the future cannot easily be audited. A mature company must show earnings. A dream company sells imagination. SpaceX has pieces that are genuinely impressive. The rocket business has government contracts, missions, reusable technology, and strategic importance. Starlink is a real satellite internet business with large revenue, subscribers, and strong margins. Those are not fantasies. They are meaningful assets. But the bundle matters. If profitable pieces are combined with an AI business burning enormous amounts of cash, the investor must look at the whole package, not the exciting parts separately. A company can have one business that prints money and another business that burns it faster than the first one can produce it. That is not unusual in booms. The profitable part lends credibility to the dream. The dream justifies the valuation. Money begins to move in a circle. One company funds the startup. The startup buys cloud services from the company or its peers. The cloud company books demand. The valuation of the startup rises. The investor marks up its stake. The higher mark supports reported profits or investor confidence. Then the cycle justifies even more capital spending that can work for a while. In a boom, circular finance can look like genius. The problem comes when the circle needs real cash flow from outside the circle. At some point, end customers must pay enough to justify the cost of the infrastructure. AI products must generate revenue that exceeds compute, labor, energy, depreciation, financing, and overhead. If the capital expenditure is enormous and the returns are modest or negative, then the market has been confusing spending with earning. But if analysts look at the expected spending and the expected revenue and find that even generous assumptions do not produce attractive returns, then investors should pay attention. A business can grow revenue while destroying free cash flow. Free cash flow matters because it is the money left after the spending needed to maintain and grow the business. In the last decade, big technology companies were loved partly because they produced enormous free cash flow. They were not just stories, they were cash machines. If the AI boom turns those cash machines into heavy capital spenders with shrinking free cash flow, the market must rethink the quality of the earnings. That is where the word earnings bubble becomes important. A normal bubble is easy to see after the fact. Price rises far faster than earnings. The price to earnings ratio expands to a foolish level. Everyone can point to the excess. An earnings bubble is more subtle. The price to earnings ratio may look reasonable because the earnings number itself is inflated or temporarily supported by accounting, paper gains, circular revenue, or unsustainable conditions. The price does not look insane because the denominator looks strong. But if the earnings later fall, the valuation was not cheap. It was an illusion that happened before financial crises. Home builders looked profitable before the housing collapse. Banks looked profitable before asset values were questioned. Semiconductor companies often look strongest near the top of a cycle because demand, pricing, and margins have all risen together. Then the cycle turns, earnings collapse, and investors realize the stock market was warning them before the income statement did. That is the hardest lesson for the public. A railroad changed America, but many railroad investors were wiped out. Fiber optic cable built the modern internet, but many of the companies that laid it went bankrupt. The infrastructure survived, the first shareholders did not. The technology won, the entry price lost. AI may follow the same pattern. It may change the world. It may also punish the people forced to buy the first public offerings at valuations that assume the world has already changed profitably. Those are not contradictions. They are history. Now consider the timing of the IPOs. If private valuations have been supported by a few large investors, going public turns those private marks into public prices. The open market now judges the valuation. If the public accepts the price, the private marks are validated. If the public discounts the price, earlier paper gains may have to be questioned. That can ripple through the balance sheets and earnings of the companies that marked up those investments. That gives insiders a reason to move quickly. They need the market to validate the paper while the story is still hot. They need buyers before the macro environment changes. It cannot be ignored. When AI-related stocks become a very large share of the market, the average retirement account becomes more dependent on AI, whether the owner realizes it or not. A person may think he owns diversified America. In reality, he may own a heavy concentration in a handful of technology and AI-related companies through broad index exposure. That is not automatically bad. The largest companies may be large because they are excellent. Many of them are excellent, but concentration changes risk. If the same companies are funding the AI build-out, booking the AI profits, buying from each other, carrying the index higher, and preparing to absorb massive AI-related IPOs, then the retirement system becomes tied to one dominant narrative. AI must keep working, AI must keep growing, AI must keep justifying capital spending, AI must keep attracting savings, AI must keep supporting earnings. That is a lot to ask from one theme. When a market depends on one theme, the theme does not have to be fake for the market to become dangerous. It only has to disappoint relative to expectations. That is another reason the window for these IPOs may matter. If the public market is still liquid, if passive flows are still strong, if the AI story is still accepted, and if index rules now allow fast entry. Insiders have a window. If oil rates, wages, or earnings break later, that window may close. Now bring in the oil and bond market problem. If oil rises sharply because of geopolitical stress, the consequences do not stay at the gas pump. Oil feeds transportation, shipping, plastics, chemicals, agriculture, and consumer prices. A serious oil spike can raise inflation expectations. Countries that import oil may need more dollars to pay for it. To get dollars, They may sell dollar assets, including treasuries. If treasury selling increases, yields can rise. Higher yields are the enemy of overvalued, long-duration assets. They are also the enemy of debt-funded AI spending. If technology companies issued large amounts of corporate debt to fund AI capital expenditure, higher interest rates make future financing more expensive. If the cost of capital rises, projects that looked acceptable at low rates may look poor at higher rates. If the Fed wants to cut rates, but oil-driven inflation is rising, the Fed is trapped. Cut too soon and the dollar weakens, inflation worsens, and bond investors demand higher yields. Raise rates or keep them high, and stocks, corporate borrowing, housing, and speculative valuations suffer. Either path can pressure the AI bubble. That is the macro trap. The IPOs are arriving near the moment when the system may be most vulnerable to rates, oil, and investor confidence. A financial boom built on cheap capital, high valuations, circular spending, and passive flows does not like higher yields. Higher yields demand real returns. They punish distant promises. They make debt more expensive. They make cash more competitive. They force investors to ask whether the story is worth the price. That is why rising Treasury yields can break things that looked unbreakable. I may not fail, but the shareholders who buy the wrong companies at the wrong prices may fail badly. That is the central distinction. Technology winning and investors winning are not the same thing when people forget that. Bubbles become easy to sell. Now, what should the ordinary investor do? The first step is not panic. Panic is usually a poor strategy. Selling everything because a scary story appears is no better than buying everything because a beautiful story appears. Both are emotion. The first real step is to know what you own. If you own a total market fund, an SP 500 fund, a NASDAQ 100 fund, or a target date retirement fund, look through to the underlying exposure. How much is in the largest technology companies? How much is tied to AI? How much concentration exists in the top holdings? If massive IPOs enter the index, how does that change your exposure? Most people do not know. They think diversification means many ticker symbols. The fourth step is to think in scenarios. Maybe the IPOs go well. Maybe AI earnings continue to rise. Maybe oil falls. Maybe yields settle. Maybe the Fed threads the needle. Maybe productivity improves enough to justify the spending. That is one scenario. Maybe the IPOs validate private valuations for a while, but free cash flow deteriorates and the market eventually questions the earnings. That is another scenario. Maybe oil spikes, yields rise, and the cost of capital exposes the weakness in the AI spending cycle. That is another. Maybe the technology wins, but the first public investors lose, and the best opportunity comes after a major reset. That is another. You do not need to know which one will happen. You need a portfolio and temperament that can survive more than one outcome. That is the job of investing, not being perfectly right. Being prepared for being partly wrong. The fifth step is to remember valuation. A great company bought at a foolish price can be a bad investment. A troubled asset bought after a collapse can be a great investment. Price is not the only thing that matters, but it matters more than people in booms want to admit. When everyone wants what is being sold, the seller usually has the advantage. An IPO is often the seller choosing the moment that should make you humble as a buyer. The sixth step is to distinguish automatic buying from intelligent buying. If an index fund buys because a company enters the index, that is automatic. It is not judgment. It is not endorsement. It is not proof that the price is reasonable. It is plumbing. Do not confuse plumbing with wisdom. Passive investing has helped ordinary people build wealth because it is low-cost, diversified, disciplined, and simple. But it also has a weakness. It buys more of what becomes large, no matter why it became large, in a concentration bubble. Passive flows can reinforce the bubble. That does not mean passive investing is bad. It means passive investors should know what phase they are in. The seventh step is to avoid the dream premium. When a company is priced on Mars, artificial general intelligence, civilization, scale infrastructure, or the next century of technology, the dream premium can become enormous. Dreams are valuable. They inspire capital and progress, but dreams do not pay dividends until they become cash flows. At some point, the investor must ask how the dream becomes earnings, how the earnings become free cash flow, and how the free cash flow justifies the price. If that chain is broken, the story is not enough. Now, if the AI bubble bursts, what happens next? Not necessarily the end of AI, more likely The first wave of investors absorbs losses. Some companies fall, some projects fail, some valuations reset, some debt becomes painful. Weak players disappear, strong assets survive. The infrastructure remains. The second wave of investors buys at lower prices. The technology continues. The world changes, but the ownership transfers. That is often how capitalism cleans up a boom. The first crowd funds the dream at too high a price. The second crowd buys the useful assets after the price breaks. It is not fair, but it is common. The investor's job is not to fund every dream at the top. It is to own good assets at prices that give them a chance. If that means waiting, wait. Cash with patience is not cowardice. If that means owning broad exposure but understanding concentration, do that. If that means trimming overexposure, do it rationally. If that means accepting that you cannot predict the top, be honest. The goal is not to sound clever. The goal is to protect capital and compound it over time. Now, I want to close with the real warning. The biggest bubbles do not always feel insane from the inside. They often feel responsible. They feel like modernization. They feel like a new era. They feel like every serious institution agrees. The banks are involved. The index providers adjust. The asset managers explain the need. The retirement funds buy. The companies show growth. The media celebrates innovation. The valuation is justified by a future too large to measure. Then slowly the assumptions are tested. Can the customers pay? Can the earnings last? Can the debt be serviced? Can free cash flow survive? Can the consumer keep spending? Can rates stay low? Can oil stay contained? Can passive flows absorb everything? Can the public buy at the top without consequence? Those questions decide the ending. I do not know the exact ending. Nobody does. The IPOs may work for a while. The market may keep rising. The bubble may inflate longer than skeptics expect. That is why a person should not build his whole life around one prediction. But I do know this. When rules are changed so passive money can buy faster, when private giants seek public exits at record valuations, when earnings are supported by circular spending, when free cash flow weakens under capital expenditure, when market breadth narrows, when AI becomes half the index, when oil and yields threaten the cost of capital, and when ordinary workers have little savings left, an investor should be very careful, not afraid. Careful. There is a difference. Fear says sell everything. Care says know what you own. Fear says the world is ending. Care says price matters. Fear says never invest. Care says keep liquidity, diversify, and wait for better odds. Fear says technology is fake. Care says technology can be real and still overpriced. That is the attitude I would want. The future may belong to AI, but the profits may not belong to the people forced to buy the first great wave at the highest price. Remember the railroads? Remember fiber optic cable? Remember the dot-coms? The world can be transformed while early shareholders are destroyed. Do not let your retirement money become someone else. Exit without understanding what is happening. Know the machinery, know the price, know the risk, and never confuse a great future with a great entry point.